Hello, Steve Lentz here with Discover Options. Welcome to the Prepared Mind. This is for July 15th, the close on Friday, getting ready for Monday's open on the 18th. Today, we have a few reports for you. The S&P 500 Condor Butterfly Timing Report for those of you that like to trade in ranging markets, and also the S&P 500 Directional Likelihood Report, both reports taking advantage of some very unique technology that we have developed here at Discover Options. We'd love for you to subscribe. Please do so by clicking on the button below. You should know that this is the video blog. There is a text blog written by Frank Fahey. Just go to discoveroptions.com, click the blog link. He has pages and pages of excellent information for you getting ready for Monday's open. Lots of volatility information, double calendar candidates off of earnings, wonderful advanced stuff. Go check it out. Before we get to the reports, if you want an ebook, just click on the link in the top right, and you can get a free ebook co-authored by myself and Jim Graham at Option View, and would love to get that out to you as well. Okay, on to the reports. There's two reports. We have the Condor and Butterfly Timing Report for those of you that like to trade within ranges, market ranges. And then later on, we'll get to the Directional Likelihood Report. On the timing report, I'm going to explain why, the methodology, and then we'll get into the current condition and where we're at and what edge level we can ascertain. Okay, you know, if you're going to put on a Condor and Butterfly and try and trade within a range, you might have back on December 31st stumbled across a trading, a ranging market and thought, oh, this is a great time. Well, we have technology now that is able to ascertain the likelihood that this would have been a good time to sell premium in a market neutral fashion. In this particular instance, it turned out not to be. In fact, there was a negative edge for selling premium neutrally. Neutrally meaning market neutral. All right, I'm trying to trade within a trade, take advantage of a ranging market. What did this mean basically? A negative edge. That means that there was a higher than usual likelihood that the market would be more volatile than what was implied by the option prices. Okay, the option prices imply a certain volatility of the market, right? If the option traders think that the underlying market is going to go crazy, well, they're going to price the options very high and imply a very high volatility level. Well, what I'm doing is really, I've spent the last 2 years trying to figure out a way to determine an edge in terms of how much premium you're collecting versus how much the market actually moves. And we try and use technicals around that and come up with some advantages here. In this particular case, our negative edge was alerting us to a likelihood that maybe it wouldn't have worked out as well, and indeed in this particular instance, it did not. The market, took off to the downside, and it would have been a very, very difficult time to put on a Condor or Butterfly and make money doing that. You would have had to have been very quick on your feet on making adjustments. So that's what we're all about here with this timing report. So let's look at the current condition now. Here's the current market condition as of Friday's close on the 15th. Thursday was an upswing day and Friday was an outside day. The high was higher than Thursday. The low was lower than Thursday. It's an outside day. And the close was a little bit lower than on Thursday. So it's an outside day. After an upswing on Thursday, we have an outside day, perhaps a little reversal going on here. We're above the 50-day simple moving average. And when we look at the overbought, oversold condition, the stochastic 15.3 is between 65 and 100, basically. It's kind of pushing up closer to 100. But it has come down, and it's underneath its 3-day simple moving average. So that's a very unique market condition, an outside day in that kind of overbought condition. You just don't see that very much. If you went back to January of 2000, how many times do you think this exact condition has occurred? Just ballpark. I'll tell you what it is. It's about 27 times this has occurred here. Not very much. So today's reports are going to be a little bit You may want to look at them sideways a little bit because there's just not that many times that this exact condition has occurred. So, but we're going to get to it anyway. Here's a question on the table. Is this current condition a good one for selling premium with range trading, condors and butters? And that's what we're going to answer. Here's how we answer that question. All right, we have, I try and ascertain an actual 21-day move from any given close. So for example, here we have a close at 2076. If I go forward in time, and I look at how far the market moved from that close, I can see the farthest it moved was down there to 2026. 50-point move turns out to be about 2.4% of the move of the market at the time when we started. Now, there it is. You can see the indicator at the bottom. What market move was being implied by the option prices at the time? This is what we're concerned about. We have the actual move of the market, and then how much of a move was being implied at that time. Okay, and in this case, when we take a 21-day VIX implied move, 21 bar, okay, which is roughly 30 days, calendar days, the VIX was implying a move of 4.4%. 4.4%, and so that's higher than the 2.4. So in this particular instance, that was a favorable day to sell premium. You were collecting a fatter implied volatility than what actually turned out to take place. So what we're going to do is paint those bars blue that turns out to have been favorable at the time. And so a favorable bar for selling premium is painted in blue. The unfavorable bars, where the market was implying a move much less than what actually took place in the ensuing 21 days, those turned out in hindsight to have been unfavorable bars. All right, and so what we want to do is kind of go back and just get the general gist of how the broad market has been in the past. And then we're going to take a look at our current market conditions, see how it compares. In other words, this, historically, here's how we do this. What percentage of all the bars going back to Jan of 2000, what percentage are favorable and what percentage are unfavorable? Okay, then once we have that benchmark figured out, we look at this. Of the bars that match our current market condition, what percentage of those were historically favorable for selling premium? I mean, what if we went back and we discovered that 100% of the bars that match our current market condition, 100% were favorable? I mean, I think you would agree you'd consider loading up on butters and condors or something like that, right? What if you went back in time and looked at our exact market condition and discovered that 100% of them were red bars, where the market moved far more than what was being implied by the option prices? Well, then you would just hang out and not trade those strategies, correct? Well, I think it's worthwhile just to go through this exercise and see what the difference was between historical, okay, and then what for our current market condition. So the difference then represents the edge that we might have, okay? All right, I think we got that. What percentage of the bars were favorable, just historically going back? It turns out roughly 2/3, 1/3. Okay, roughly 2/3 of the bars, 64.7%, were favorable for selling premium in a neutral fashion through range trading. A little bit more than 1/3 turns out to have been unfavorable, where the market was moving up quite a bit more than what was being implied. All right, so that's kind of the benchmark level now. Let's now look. And then here, of the bars that match our current market condition, what percentage of those were historically favorable for selling premium? So unfortunately, it just didn't happen that long. We have the bar, happening now. This same condition occurred in March one time. Its same condition occurred, looks like early December. So it just doesn't happen that often. And when you go back in time and see, Okay, roughly 80% of all of those bars going back, of those few bars, those 27 or so occurrences, roughly 80.7% turns out to have been favorable for selling premium. Roughly 1 bar in 5 turned out to be unfavorable, where the market was more volatile than being implied by the options. So our edge then, and I didn't replace this. This should be, I apologize here. I'm just going to blank this out. Here, you know what I'm going to do? I'm going to grab this. That's wrong. You know what it is? It's 16% edge. We have a 16% edge because 80.7, okay, 80.7 minus 64.7, you can see there, is equal to 16. Okay, 16% edge. That's what it is. That's what our edge is for selling premium at this point. Okay, all right, let's go on to the directional likelihood report. Before we do that, I want to make sure you're aware of the wonderful mentoring classes we have at discoveroptions.com. We have a wonderful staff of professional option traders ready to help you learn how to become an expert options trader yourself. And whether you want to make some routine monthly income through your efforts, or to speculate occasionally and you just want the best strategies for speculating directionally, or perhaps you have a portfolio of long holdings and you want to create an overlay, an options overlay, to enhance your yields and reduce volatility. We can cover all of that through our courses here. They begin at just $99, just to give you a feel for what we're like, and then it goes all the way to the equity track or the futures track if you really want to dive into some of the more advanced approaches to making money in the markets using option strategies. Okay, now let's go to the report. The S&P 500 directional likelihood report. Just want to review the current market condition again. Overbought territory, have an outside bar, possibly a reversal situation up there, but we're above the 50-period moving average. All right, so if we look at this condition, here's the directional question we have. Since Jan of 2000, how often has this same condition occurred, 27, and what direction did the market go typically for those 27? So what we're going to do there is, instead of looking at a trading system with trailing stops and all that and trying to figure out a profitable way to make money off those 27 occurrences, what we're going to do is just look at a simple historical distribution of price. Okay, we're going to see how is price distributed, all right, randomly throughout the history of the market going to Jan of 2000. Then we're going to look at the distribution from those 27 occurrences. All right, and if we find out that that these 27 resulted in the market going down 100% of the time off this current market condition, well then we're going to load up on the bearish side, right? But how do we measure the distribution, bullish or bearish? And so that's what we do here. I'm just going to show you how we do this. Then I'll show you the results. We measure this, the distribution of price, by observing how often price touches a 1 standard deviation volatility band that are placed from each bar's closing price. So I divvy this up into trading bands, 5, 10, and 15 days out, 1 standard deviation using a 20-day historical volatility, and they're normally distributed, of course. Here's an example, then I'll get to the results here. Volatility bands. We're setting these bands 1 standard deviation up, 1 standard deviation down, and they go out about 10 days. Question on the table is for this close, did the market hit the upper, the lower band, or wobble in the middle? All right, in this case, the market clearly went up, and we would then denote in our database here that for this particular close, the market hit the upper band. Now for this close, what happened? Here's the upper band going out 10 days, the lower band going out 10 days. Did the market hit the upper, the lower, or wobble in the middle? And there, if you look real carefully, here's the band here, and the market did not quite hit the lower band. So in this case, it hit neither of them. So that's what goes in our database for each of these closes. And so what we do is we look for every close, we record how often price struck the upper and the lower 5, 10, and 15-day bands. All right, and here's how the statistics work out. Through July 15th, from Jan of 2000, oops, I keep forgetting to make that date better. Sorry about that. It hits the upper 5-day band almost 30% of the time. It hits the upper 10-day band 23%, upper 15, 23%. The lower band, lower 5-day band about 30%, the lower 10-day about 30%, lower 15 about 32.4%. So you're and this is out of 4,100 signals. So you're seeing here that generally the market will hit each of the bands roughly 23 to 30% of the time, in that ballpark. Okay, so that's the benchmark. Now, let's take a look at what happens just after our condition exists. And so what we do is we go back and I mark each bar where our condition existed, and I'm going to look at the distribution of price from the close of the bar. I'm going to look at the distribution if price goes above the high the next day. Okay, and then what if it goes below the low the next day? So here it is Friday. So on Monday, the 18th, if price goes above the high of Friday, what's the distribution of price then versus the distribution if price goes below the low of Friday? Okay, we're going to examine that real quick. So look at this. Of the 27 times that this market condition occurred, all right, I'm going to switch colors here just for grins. There we go. 27 times. Of those 27 times, just looking at the close, okay, it hit the upper band a little bit less often than just randomly, historically. It hit the upper 10-day band a little bit more often. Hit the upper 15-day band quite a bit more often, 33% of the time, instead of 23%. So it hit 2 of the 3 bands on the upper side more often. Look at this though, it hit the lower bands less often across the board. Not by very much, pretty much, well, just tiny bit underneath. Look at that. But again, it's only 27 bands. Usually I like to have at least 100 here, if not more. So we're operating kind of thin in that regard, but I wanted to report this to you anyway. So that's as of the close. How many times of those 27 times did the market go above the high? Not very often. Okay? Only 4 times did it go above the high. And each of those 4 times it failed to hit the upper bands across the board for all 4 times of that occurred. When it went above the Friday's high, it then went and it would hit the lower bands. Just look at that. Let's see here. It hit the lower 5-day band 100% of the time. But again, that's just 4. All 4 times it hit the lower 5-day band. So I'm not giving much credence to that. It's just not that often. We need more of a data. And there's no changes I could make either. The way I labeled the current market condition, it wasn't. I couldn't loosen it up very much. If it goes below the low, 15 times it occurred where it went below the low of Friday. And you can see here it failed to hit 5 of the 6 bands as often as randomly historical. So no huge bias here. But if you were to put some credence, I would look at the 27 all in all. Sometimes you had inside days, making it such that you had 15 and 4 do not add up to 27. It's because some of those days were inside days. But of the 27, the lower bands are hit slightly less often. The upper bands are hit slightly more often. So this indicates a slight bullish perspective. Okay, leaning on the bullish side. If the lower bands are hit less often, the upper bands are hit slightly more often, you would lean a little bullish then in your bias. Now, when we construct these bands, we're using a 20-day vol level, 20-day historical vol. What if you use the VIX? What if you use the VIX? And that's the question here. And I use the VIX and I skew adjust it so that the upside volatility is lower than the downside volatility. So the bands in the VIX are going to be farther out. VIX is usually higher than the 20-day vol. So the bands don't get hit near as often because they're farther away. But let's just look at the results here. Okay, at the close, okay, of those, well, this is 26 instead of 27, interesting. Okay, the lower bands get hit less often, just kind of like up there before. And one of the three upper bands gets hit slightly more often. Two of the three are hit less often. So all in all, I would say that this is looking kind of more bullish because just because of the numbers, the lower bands are getting hit far less often, and the upper bands not quite so much. All right, let's go to the next one. If the high is taken out, well, then the lower bands get hit more often. But again, that's only 4. I'm just going to skip it. That's just not enough. And on the 15, the lower bands are getting hit less often once again. Similar pattern. Slightly, if you're going to lean it directional, based upon the history here, you would have to conclude that the bullish side would get a slight thumbs up here over the others. Okay, suggested strategy. Okay, hedged bull put spread seems to be working out, especially if you're slightly bullish. It's not a condor or a butter. It's a different strategy that kind of takes away the headache of those big upside moves, kind of like what we've seen lately. So if the VIX now is at 12.7, I like to skew adjust the VIX so that the downside vol is a bit higher and the upside vol is a bit lower. That way I can go to option view. I'm going to take this 14.6. I'm going to stick it into option view right here, 14.6. That then gives me a standard deviation right here. I'm going to sell some premium in a 20-point spread. I'm going to buy a bear call, or excuse me, a bear put spread here to hedge this credit spread. I make sure that it's bringing in a net credit. And when we run the numbers like this, we get a nice, good credit spread that has a nice, just a beautiful hedge on it right here. You'll still make 6% if it goes up. If it goes down, then that hedge is kicking in, and you're really flaring out these intermediate T plus lines so that you're not going to lose very much if it continues on downward. And when you look at the little birdie thing, the birdie being this little profit and loss button, looks like a very wide green area, right? If the market goes up, you're going to make 6%. If it comes down, you could certainly make more than that. I think, what do we say? You could make, look at that, 17%. If the market ends up, coming down right around here or so, 17%. Not too bad. 6% up here, 17 there. Okay? All right, just an idea for you. Perfect. Folks, thanks so much for joining us. I'm Steve Lentz with Discover Options. This has been The Prepared Mind. We'll see you next week. Good luck trading. Bye-bye.